Okay, here we go. Um, okay, Fonzie. Here's the buy presentation for Netflix. Thanks for doing this. So wait, let me get to the next slide. Okay, here we go. So I'm going to start off with just an overview of the company's obviously we know what Netflix does, but I'm going to start with a little overview of how the company makes money, its margins. Then I'll go into the key drivers for revenues and margins, what's been happening to the stock price, the valuation, and then I'll go into why I think it's a buy. So in terms of revenues, so revenue growth, if you look at that first chart, it's been pretty exceptional for the last 15 years or so. The company's revenues have been growing about 24% CAGR since 2007. Now, most of these revenues now is coming from the streaming segment. So the subscription fees that we all pay to use Netflix. Like previously, there was a few percent coming from DVDs, but now the company's actually stopping that this year. So there's two. So where does that 24% come from? There's two main components. Okay, so there's subscriber growth. That's more and more people using Netflix, and then there's the average revenue per subscriber, the pricing element. And so we can see that over the last 10 years, the main driver has been subscriber growth. Like it's gone up from 20% a year since 2014. If you look at that second chart, international subscribers has grown from 1 million in 2011 to 156 million in 2022. So it's really outpaced the US kind of growth. And then the second element is average revenue per subscriber. So like every year, Netflix can bump up their subscription fees somewhere around the world. Obviously, in the US, they don't lift prices every single year, but somewhere around the globe, they're lifting prices by around 5% per year. And the main thing to talk about, we'll talk about in a couple of slides, is that this subscriber growth is a concern because it has been decreasing. And even if we look at that US chart, it is off a lot. So that's something to keep in mind. Then, if we look at margins, so yeah, gross margins for the company have really grown from 27% in 10 years ago to 39% now. EBIT margins have grown from around 1% in 2012 to around 18% now in 2022. If that first chart, you can see the company's not your average kind of like tech company. They became profitable just 5 years after they were founded. And like, I know you love those margins. Those margins just been going up lovely over the last 20 years or so. And the reason for that mainly is because of cost of revenue. So like the company has three main cost buckets here. They've got cost of revenues, marketing costs, technology costs. I'll just quickly say what each of them are. So cost of revenues is the main bucket, and this is the cost to acquire and create content for their platform. So all the shows that we see on our streaming platform, they either have to acquire that from a company like Sony, so they get movies like Spider-Man or Jumanji and things like that, or they have to create the content themselves. So like there's a big movie with Ryan Reynolds and The Rock called Red Notice. Then they'd spend £200 million for that. The Crown series is costing them around $500 million to create that series.
Yeah, so actually, I think they're also spending 100 million per year for the Friends TV show as well.
The Friends TV show, yeah. So they're spending a heck of a lot of money. The one thing to keep in mind here is that like that 200 million on the Red Notice, that doesn't go straight into the income statement. It's like content amortization. So over like 5 years, they'll put 40 million a year into the COGS line for that. The second thing is marketing costs. So like obviously they do some like typical advertising, but when we talk about marketing costs for Netflix, it's actually distribution kind of payments. So I'm not sure if it's the same in Spain, but like in our remotes here, in the UK, like there's a Netflix button and things like that. And I never realized that Netflix pay £1 to all these companies when a smart TV is sold. And £1 doesn't sound like a lot, but there's 200 million smart TVs in the world. And so Netflix paid £200 million just for that Netflix button every year, which is crazy. And then the second thing is these integrated service providers. So like these are these like Comcast and AT&T who basically deliver the content to households. And like Netflix and YouTube, these streaming platforms require a lot of bandwidth on the internet. And so because of the impact they kind of have on ISPs like BT in the UK or Vodafone or MásMóvil in Spain, these companies are having to invest a lot in their infrastructure to allow for the increased bandwidth. And so Comcast and AT&T actually said to Netflix, you're going to have to pay us for distributing to consumers. And so Netflix have to actually pay Comcast, AT&T. Something we'll talk about later is Vodafone, BT, European companies are now also going to ask Netflix and streaming companies to pay them as well for these upgrades in infrastructure. And then the third thing is technology costs. So like, because of these costs to Comcast and AT&T, Netflix have created their own content delivery network called Open Connect, and they've invested like £1 billion to create their own network. This basically like allows them to distribute their product easier around the world.
Does this actually mean they are bypassing other like Vodafone or ATT?
No,
it's
not. It's not that they're bypassing it. It just means that it's easier. It's free for Vodafone and BT to like take that content from like a local server and then send that to like customers.
Okay.
But Comcast basically don't use it because they know they can take fees from Netflix. So that's the thing. But like the main reason, because tech cost of revenues make up the bulk of cost, the main reason why margins have been going up is because even though cost of revenues has been going up 22% a year, their revenues have been outpacing that. And so the percentage of revenues has gone down from 73% in 2012 to around 61%, I think, is in 2022. So that's where the margin expansion is really coming. Okay. Next thing to look at is, how are these things going to be impacted going forward? So like, as I said, when we talk about revenues, subscriber growth is really slowing in the US. Like, there's two main reasons for that. Like, market penetration is already high. Like, most people in the US now are aware of Netflix. If they were going to have Netflix accounts, they would have already had it by now. And Netflix in Q1 of 2022, last year, they actually had their first subscriber loss ever. They actually lost 200,000 subscribers. So that was a worry. And we'll talk about the impact on the stock in a second. And the second thing is competition is fierce. You know, Disney Plus, HBO Max, all of these guys are coming up with their own streaming platforms. And so now if people can only afford one platform, they have to think about, oh, should I go for Netflix or Disney Plus? And they're canceling. So like that's having an impact on subscriber growth. The second thing, which is more positive, I think, is average revenue per subscriber. And so what the company have done is, first thing is they've gone into advertising, something that they never thought they would do for a long time. But because of the pressures on subscriber growth, they've said, we'll have this new tier where it's basic with ads. And even though it's cheaper, the company is saying that the average revenue is going up because companies like Nestle, Unilever, Coca-Cola, they're paying a lot of money to advertise on Netflix. And so even though let's say the basic plan is £9.99, the basic with ads is £6.99, even though the subscriber is paying £3 less per month, the revenue you're making from advertising is making up for that shortfall. So Netflix are actually increasing average revenue per subscriber through ads, which is very interesting. The second thing is they're really cracking down on passwords. So they've got about, as I said, like 230 million subscribers. They're saying around 40% of those, they're saying there's an extra 100 million people who are using Netflix, but without paying and that's true, definitely, because like there's about 3 people on my account who use Netflix without paying. But Netflix, to stop that, are saying from now on, I think it's coming to the UK soon, is I will have to pay an additional fee for those people to use my account.
That's already implemented here in Spain, actually.
That's
Netflix says it has lost 1 million accounts in Spain, at least 1 million accounts.
No, but a lot of those weren't paid accounts, Fonzie. So I think only 30% of those were paid accounts. And Netflix actually talk about that. They say that with this, we'll have an initial loss of subscribers, but actually you've seen in Canada, since they've done this, subscribers have actually gone up, because now, let's say there's 3 or 4 friends of mine who wanted to use Netflix, they'll now have to subscribe themselves.
Okay.
So the impact on subscribers is fairly neutral, I think, maybe positive, but definitely it's an increasing impact on average revenue per subscriber. And then the final thing is macro pressures. The company actually reduced prices in 30 countries earlier this year. They're actually reducing it in a lot more, I think, further on this year. But as macro pressures hopefully ease, as inflation comes down, cost of living crisis comes down, I think you'll see the company really increase like pricing going forward. And also effects is a big thing here as well, where we'll talk about it in a few slides. I won't go on more here. And then the final thing is, which I don't think is too much of an issue, is content prices are continuing to become more expensive, because, I mean, there's only a limited number of shows that Ryan Reynolds and The Rock can do. And if Disney, everyone is looking for them to secure them for films, they're going to be demanding higher salaries. And like, there's only limited places where you can film these places. And so the rent for all of these shows are going to go up as well. However, because Netflix have got this subscription fee and it gives them great visibility into revenues, they can they can manage kind of how much they're going to spend on content. So I don't think that's huge negative here. If we just go forward to the stock price, so like, how has this impacted the stock price? So we saw for the last decade up to Q1 2022, there's really strong momentum in stock price, fueled by the strong like subscriber growth. Then we saw in January 2022, they didn't actually announce the loss, but in Q4 they announced that they expect subscriber growth to slow because of increasing competition. That was enough for the stock price to fall. And then in April 2022, the Q1 results showed a loss of 200,000 subscribers. The stock price fell 35% on the day, which is why, yeah, you can see in that top chart there. However, which is what I think is quite interesting, is that sentiment has really shifted over the last year. The focus is now less on subscriber growth. Netflix actually said we're going to stop reporting our subscriber numbers. Disney Plus have said the same. We're going to stop reporting them. And so if analysts can't see that, they're now thinking, well, we have to kind of look at average revenue per subscriber, which is what the company is talking about, and we need to see whether that's going to be lifting revenues in a similar way. And so sentiment has bounced. And as we look at this valuation chart, I mean, for the last decade, you haven't been able to use normal valuation metrics to value Netflix. But now that growth is slowing, you kind of have been over the last year. It's not perfectly clear, but in April 22, when that Q1 report came, EV/EBIT actually fell to 14 times. So this is FY0, so like based on the year before, which is incredibly low for a company like Netflix. It's still producing a lot of cash. I know you want to come on to that in a second, but sorry, I just saw actually this is kind of like real life. In a real life Zoom meeting, I saw the 10 minutes left, so we'll start again in 10 minutes. But as I said, yeah, sentiment has really improved over the last year. Now, the next thing to look at is what is priced into consensus. So what is the stock? Yeah, within that $325 for the Netflix price, like what is currently priced into it now? And so consensus is saying that revenues are expecting to be 7% per year in FY 2023. This is, I think, slightly conservative, maybe. Like we saw Q1 2023 revenue growth was 4%. Management have said that for the full year, this will really pick up over the course of the year as like the year-on-year comps improve. And then going forward, the next couple of years, consensus are expecting like low double-digit growth for FY24 for 25. In terms of EBIT margin, management have guided for this year for between 18 and 20%. Consensus around the mid mark, and they're expecting quite substantial expansion over the next couple of years. However, although that looks quite expensive for 2024, 250 bips, it's not actually that expensive because this year's margin has been impacted a lot by FX. If it was X effects, that margin would actually be this year around 21 to 22%. So like it's kind of similar to that next year. And what does this imply, these estimates, given the stock price of 325, is an EV/EBIT valuation of around 24 times here, but it goes down to 18 times and then actually less than what the company was valued at even in April 2022 if we look out to 2025. So what are my estimates here, and like where do I think there could be upside is, yeah, my kind of view. So like what I really think is, maybe I'll read out that paragraph, which is the investment case, and I'll dive into that more. Is like after that shock of Q1 2022, management have been very conservative in their guidance. And because of that, I believe there's potential for Netflix to meet or modestly beat near-term earnings estimates. And if Netflix does meet or modestly beat earnings estimates over the next few quarters, I think we'll see sentiment continue to rise for the stock, leading to more multiple expansion. And then I know you want to talk about cash generation, but I believe there is strong cash generation and debt pay down over the next few years, which will help the valuation as well, which is we're going to see the company go from net debt to net cash over the next couple of years, but we can talk about that if you have any questions. But in terms of revenue, so there's plenty. Listen, as I said, I think we only need modest earnings beats for the valuation to rise further. What I'm saying is for FY23, we might see around 9% revenue growth. This would leave us about 2% above consensus. And the reasons is because I think there's plenty of upward pressures on average revenue per pricing. Like we said about advertising tier, paid sharing, FX headwinds will ease towards the end of the year. And then in terms of margin, I've kind of just gone midway to what management guidance have said, 18-20%. I've gone 19%, which leaves us about 3% above consensus EBIT estimates for the full year. Going out to 24-25, I think we could see a lot more benefit in terms of top line. And the reasons for that are because of FX headwinds. I can't tell you how impactful they've been on this year's earnings. So average revenue per subscriber without FX is actually around 5%, 6% this year, but because FX takes around 5% off of that. So that's why you're seeing the consensus.
So you would actually, sorry to interrupt you, you would say that actually when we go to the top line growth, for instance, the 15%, you would say 5% is pricing power and 10% is subscriber growth, or how would you split that number?
I would say, so it's a good question. So at the moment, for that 9% is coming around 6-7% subscriber, and it's only 2-3% average pricing because of FX. Whereas when you go out to FY24, if you change that FX effect, that 2-3% pricing becomes 7-8%, and that subscriber stays around 6-7%. But I think so 6-7 plus 7-8 gets you about 15%. I think they could be even more upward because I think average revenue per subscriber could be around 10%, which is what it was, by the way, for quite a few years. XFX. And then in terms of EBIT margin, I've actually gone slightly below consensus estimates because I think they're fairly bullish on margin anyway, which is why even though we're saying 6% B in terms of revenue estimates, we're saying only a 2% B in terms of EBIT estimates. Now, as I said, a large part of the valuation case is, because we're only saying marginal beats on EBIT, we're saying that's all that's necessary, we think, for the stock to, I keep saying we, but it's obviously me. That's all I think is necessary for the stock to re-rate in valuation. So I'm saying instead of it trading at around 13 times here, like what consensus estimates are saying, we're saying it might re-rate to around 20 times, which is still below the 27 times it's currently on. And that will get you to 16% upside or 51% upside if we're looking out to 2025, which is ahead of what we think the market will do. And I think another big part is not the reason why I think, especially for a company now like Netflix, for it to meet or beat earnings estimates is really important because of paid sharing, advertising tiers, all of these things, the company's visibility into revenues is a lot less than it was previously. The management have said that themselves, and they recognize that there's a few new rollouts happening at the moment. And I think in a couple of years, once those are really filtered through, there'll be a lot more visibility on Netflix's new kind of revenue model. And I think the market will kind of appreciate it as well and have more confidence, and sentiment will turn, which we will see in the valuation. Now, where do we think this will go wrong? Last slide, and then you can fire questions at me, so obviously a big part of this is that the pricing growth really accelerates around 10% a year. The reason this might not happen is if the ads plan doesn't generate the kind of ad revenue Netflix wants, if your Nestle's, Unilever's, Coca-Cola's prefer advertising elsewhere, they don't kind of generate the advertising revenue Netflix require. If they don't feel that they can raise subscription prices anymore, I think they've still got plenty of pricing growth. I mean, at the moment, I can't remember how much I pay per month for Netflix. Maybe let's say £12 or something. That's the price of an expensive cocktail in London. I think I would spend a lot more on Netflix. I'd spend a lot more a month on Netflix. So I think they've got a lot more pricing growth. But let's say cost of living crisis happens, they can't do that. And then the other thing is obviously if FX headwinds persist, that's going to be continuing impact on top line. Now, and margin. The second thing is if subscriber growth turns negative, like you said, in Spain, there was the initial kind of impact with people leaving their subscriptions. And maybe this isn't fully baked into the price. If more and more people do leave and their friends don't subscribe, you could see subscriber growth turning negative again, like you saw in Q1 22, which would leave the market really panicking. The other thing I forgot to actually put in the slide is when it comes to the costs, I don't think content costs getting expensive is really going to impact things because, as I said, I think they've got very good cost control there, and their spend on content is actually very much in line with their kind of amortization of that content. However, I think the cost impact could come from that integrated service providers. As I said, the BT, the Vodafones, if they then start charging Netflix, that's something they don't really have much control over. And so that could erode their margin a little bit. And so, yeah, I think this is a buy. I think there's sufficient upside. And I think looking out for management comments over the next couple of quarters is super important. Like what is happening with average revenue per subscriber, what is happening with subscriber growth, and any kind of things that we're hearing from companies like BT and Vodafone about what they might charge for Netflix delivering the service. So yeah, that's pretty much all I have. And I'm happy for you to ask some questions, Fonzie.
Thank you very much for the presentation, Nigel. So I just have like...
Sorry to cut you off, PM. But should I just close this Zoom down and start a new one? Okay. Yeah, happy to take any questions, Fonzie.
Nigel, thank you very much for the presentation. So my questions, like basically, I'm dividing my questions into the more quantitative and the more qualitative. So on the qualitative side, my doubts are like, what do you think is Netflix's biggest economic moat right now?
Biggest economic moat?
Yeah, main competitive advantage. Is it the brand? Is it the economies of scale? Is it like, what is the company actually main moat in order to defend from competitors right now?
Well, I think it's a good question. I think they have. I think the thing that is the most important thing for this company, for every streaming company, is the content. And what do you need to do to have the best content? You need to be able to spend the most money and spend the most money so you can attract the best talent, best locations, things like that. And Netflix, ahead of any of these other companies, have the best content, and they've got like a really good subscriber base that, sure, there are some people who are churning, some people might go to Hulu, HBO Max, all of these things, but they are happy with the content that are on Netflix. And if you that, I mean, I can't say any other way, to be honest. Like, I think for a company on Netflix, the most important thing is their content over anything else. And yeah, I think you could argue that. I mean, absolutely. I think that's
content for a streaming company seems to be like the most reasonable answer out there. Yeah. Besides brand. Like my doubt, and that's related a little bit with my numerical questions, is like competitors, from what I've seen, are really catching up. Like Netflix was the first player, but just by looking like at the key figures, this year, apparently, from what I read, like Googling quickly, Netflix actually cash spent on content for 2022 is going to spend basically 16 billion. Okay, 16.
Yeah.
Amazon is going to spend 16 billion as well, and Disney is going to spend 33 billion.
Yeah.
So that's where, like, if I was going to spend my money, I would be like a little bit worried with those figures, because I would say, okay, and then on top of that, you actually need to keep in mind, according to Netflix, they amortize their content on average every 4 years. So that basically for me means every 4 years, all the content you spend, all the money you spend, resets, like disappears. It's worth zero according to them. So every 4 years, your competitive advantage gets reset. So according to these figures, starting from 2022, in 4 years, you're going to be outpaced 8 times or more than 8 times on Netflix, and you're probably going to be outpaced by Amazon. So my question when it comes to this is, where is Netflix going to be in 4 years if competitors are going to invest the same or maybe twice the amount Netflix is spending per year? That's what actually worries me about Netflix as a business case.
I mean, I think if you look at the content as a not trying to get too much of a personal opinion of this, because I think when you have a personal view on a company, like, it can cloud your judgment, because they're 200 million subscribers. So my view doesn't matter too much. But the content that you see on Netflix is also very different to the content you see on Disney Plus. Also very different to the content you see on Amazon Prime, kind of thing as well. I completely what you're saying is true, 100%, and that's as I said, one of the bigger risks for subscription growth is that people would go to Disney Plus, would go to Hulu, would go to HBO Max,
or HBO or Amazon absolutely. Prime, any of those,
absolutely. But I think the people who are, I think it's a very sticky business. I think the people who are happy with Netflix and happy with the content, and they're continuously producing new content and hits as well, Carlos. Like they're producing content that is winning awards regularly. Like they're some of the most viewed shows around the world on any kind of like service, like whether it's linear TV or the streaming TV. And so Yeah,
Yeah.
I think as long as the quality of content they're producing is strong, I think the churn. I mean, you can see historically, like the churn rate for a company on Netflix is around 2-3%. 2-3% of the subscribers maybe leave every year, and I think that's fine. To be honest, I
Yeah, you
don't.
know, like the churning rate for me, like at this point, Netflix reminds me of the smoking companies when there were no competitors, because the historical churning rate of Netflix for me is irrelevant up until actually new competitors arrive. Because like I heard one analyst, actually one portfolio manager, say you cannot assess the strength of a mode until it gets attacked. So actually, Netflix mode just got attacked recently, and I mean maybe like the last 2-3 years ago.
Yeah,
So all of the figures for me before 2018, maybe 2017,
yeah,
okay, I mean they're useful, but they're not like the actual Netflix company anymore.
yeah,
And same in tobacco. In the smoking company, if you start seeing the vaping industry, the heated tobacco, the smoking rates are actually going lower
yeah,
for the last 4 or 5 years. Something similar is happening here.
yeah.
So that was my question.
I completely agree, by the way. And just
Yeah.
something thing I'd add from this point is I 100% agree that the moat is now being attacked. But that is why I'm not saying that there's going to be subscriber growth at 20%. We've been saying
Yeah.
for the last decade subscriber growth has been 20%. I'm saying subscriber growth might be 5-6% going forward now. And that's not even coming from the US. That's mainly coming from APAC regions where subscriber growth is still 18-20%. So that
Underpenetrated. Okay.
yeah, that's where the growth, subscriber growth is coming. Overall, maybe 6%. I'm saying a lot of the growth is coming from pricing growth, as I said today. It's like average revenue per price, so per subscriber. So yeah.
Yeah. Also, it reminds me the Netflix button here, which I had no idea about, and I think it's actually a very good marketing strategy.
Yeah.
Amazon also has it here in Spain.
Yeah. I
which
think
is
Disney
which
Plus
is
have it in a few places now as well. So.
yeah, which is like I think Amazon is like copying what he says they like, and they're actually copying. And like regarding sort of linked to the content creation, something that worries me a lot is the cash flow, the cash flow statements I mentioned to you before. Because like
Yeah.
actually, if you look at their earnings per share of the okay, we'll talk about a little bit about the amortization afterwards.
Okay.
EBIT actually grew from 4.3% in 2016
Yeah.
to basically 20% almost in 2022.
Yeah.
That is true. So EPS actually grew a lot, but cash has been a problem actually. Like if you check the free cash flow generation, and I'm only talking about cash flow minus capex, in the last 7 years, the company has made minus 6 billion. So the
Yeah.
company has had some very, very serious cash problems. It's been forced to issue debt, increase the number of shares. So I'm a little bit worried because as I've told you, basically the EPS, it's true, the EPS has gone from 0.4 to 9 to almost 10%, which is amazing, but cash flow is worrisome. And I say it's worrisome because in the next 12 months, right now, the company is having trouble. But in the next 12 months, the company has to pay almost 11 billion cash. The company is going to have 11 billion. It's going to face between content obligations, debt, and operating leases almost 11 billion. We're talking about 11 billion when the company generates this year, which has been the second best year in the last 7 years, 1.5 billion. And the company has to pay upfront next year 11 billion. So the company is going to be forced probably to issue some debt, reduce cost, or do whatever. And this on top of competitions, which is Disney and Amazon, swimming in pools of cash. So actually competition, Disney is spending 33 billion. Amazon can spend 16 billions easily. This company, Netflix, if competition gets tough or if debt needs to be refinanced at higher rates, can face some issues, in my opinion. I mean, as I've told you, I would need to look deeper into the company, but cash for me is a problem in this company.
No, but Fonzie, I think what you're talking about is there when you're looking at the cash flow statement for a company like Netflix, so you've got the net income, and you need to add back that amortization though, because
That's
so
at the
yeah, but if you add back the amortization, so let's look at. I don't want to take off this slide in case it goes away. But actually, you know what? I'll okay. So maybe you can tell me. So like the net income for last year, what was it for?
Just give me a second.
Actually, I'll get it up on my here as well.
Okay, I have it here.
Yeah, if I get my model,
Net income was
you can see this.
basically 4.5 billion.
You can see on my screen.
Okay. Yeah, perfect. Okay,
Yeah.
perfect.
Okay.
Yeah.
So net income here is 4.5 million.
Yeah.
4.5 billion. Sorry.
4.5 billion. Yeah.
Yeah. You add back that amortization there, that gets you to around 18.5 billion. Okay. Then they're spending, yeah, I agree, pretty much all of that on adding to content assets. But after that, I'm not sure there's like that much. I mean, they lost just under a billion last year in terms of cash. Like, I think it's very manageable, no?
I'm looking more, skipping the financing side, looking at cash flow from operations. It's quite thin, the cash actually they generate compared to all the investments they're making. Like they're having issues. If you look at, I'm looking, for instance, from 2016 when they generated minus 1.4 exactly.
Yeah.
If you take away the purchase, only the basic like PPE.
Yeah.
They actually made negative in 2017.
Oh yeah.
Negative. So they're
Completely.
actually, and that's actually including the content creation and all that stuff.
Yeah.
But
No. Okay, let me just answer you that one quickly. Fonzie, is with this, I completely agree with you because over here, what you see is they were adding a lot more than amortization. So
yeah,
they were running. So net income plus amortization here is around 5 billion. They're spending 8.6 billion on content. And that's why the companies had to take out debt here.
exactly. That content that nowadays, according to their own estimate, is worth zero.
No,
Because they
but
amortize it every 4 years. That's
no, but just quickly, what I mean in terms of cash though is they're spending a lot more. Now, that's not the case. If you fast forward to let's go 2020, net income plus amortization is 13.5, they're spending 11.7. Here, net income plus amortization is 17.3, they're spending 17.7. So they've said themselves, now we don't need to take out any more debt. And they're actually, look, if you look at this, they're repaying debt here. So the company is no longer, I don't think, in a situation where they're going to be spending so much on content that the cash is going to look so bad. Because I agree with you, before it was worrisome and they had to take out a lot of this debt here, whereas that's not the case anymore. They haven't taken out any more debt the last 2 years. They've said they're going to repay all of that debt down. So yeah.
you know, actually, yeah, if you look at them, I did a quick numbers, and if you just actually see how much they're making per customer monthly, dividing by how much they're actually spending on technology, cost creation, and all that stuff for the last 3 years, they've actually improved a lot. They're going from
massively
basically break even to plus $3 monthly in profit per customer. But cash, that's like I was like what I was telling you, with all the upcoming content obligations debt in the short term, for me it's quite worrisome. I mean, I might be completely wrong, and in the next 5 years, Netflix skyrocketing.
Yeah.
But in this case, I would say, like in the current environment with all the macro headwinds and all the increasing interest rates, plus all the competition, because I was telling you, like in 4 years, Disney can spend maybe 120 billion. If they continue like this, Netflix, they can spend maybe half of it. So in 4 years, Disney is going to have 60 billion extra in content, plus Amazon. So
yeah.
I'm not that sure how. I mean, I think it's a very, very well-known brand, but I'm not sure how well it's gonna survive the next 5-10 years. Actually,
I think that's
I'm
fair
just
enough.
getting reports on.
No, I think that's fair enough. I think the thing with Disney, you've got to look at them as well, though. Like if we look at Disney, like they've got around 160 million subscribers on Disney Plus. They own Hulu Plus and they own ESPN Plus as well, and so they've got around similar number of subscribers to Netflix, but their revenues are around 50% less because their average revenue per subscriber is around 50% less. So for
Exactly.
Disney, though, you've got to think if they start increasing the prices, people might leave Disney. So and the thing with Disney is it's a very you know, like a show, like a show like Night Action that's come out
Yeah.
recently on Netflix, or the Dharma story on Netflix. That's not going to be produced on Netflix on Disney. So the genre of shows that you see on Disney are very different to the genre of shows you see on Netflix. So I think as well, when you're talking about the moat of like Netflix, it's the content is very differentiated as well from a Disney. So
Okay, Disney, I agree, but not. I don't agree if you compare with Amazon, with HBO, maybe Apple TV late recently. I'm not sure. Also, actually, and this is not a question, I was very surprised because I was checking the average monthly revenue per customer, and I thought Netflix had like much more not pricing power because they didn't increase the prices not because they were unable to, but because they didn't want it to.
yeah,
But they actually only increased prices 4%, 4.5% basically since 2014,
yeah,
which
it's about
seems
5%.
quite reasonable. And also when I'm checking for the last 4 years in the States,
Hmm.
Amazon Prime and Netflix have both increased prices basically at the same rate, which is 4% per year,
Yeah, yeah, yeah.
which like makes me come up with more questions like have they increased both 4% because they are both watching their competitors or
Hmm.
because they can't increase? Because when you have these two giants of content and they only increase prices 4%,
Hmm.
makes me like raise more questions. Like, why haven't they increased more?
Yeah,
Why
I think it's a
4% seems little actually. When inflation is almost 3%, it's
yeah,
making in terms of real price, they're only making 1% profit increase per year, which seems
yeah.
ridiculous for these
But
companies.
I think for these companies for so long, what was driving revenues was subscribers. So you didn't need to lift revenues too much. I think so. Prices too much. Whereas I think now, like I said, I think that's going to happen more going forward. But yeah,
And that seems reasonable. Basically, I mean, I think it has a lot of potential, but faces many threats in the short term.
okay,
Like, but that's been always my view with Netflix. Like, if it was when it was 2012,
yeah,
I also thought that what worries me is the next 4 years. Then in 2016, I was like, I remember when we were back in Madrid, I was like,
yeah,
oof, this company is burning cash.
yeah,
I don't see the company surviving in another 4 years.
yeah,
Right now we're in 2022. That's
yeah,
my
yeah,
impression
yeah, yeah, yeah.
again. And time has proven with this company, I was wrong. So maybe I'm wrong again in 4 years, but my worrisome comes with the cash flow and all the new competitors arriving. So
Yeah, interesting, interesting. I think my point. I think you're completely. I mean, you're the portfolio manager. You know more than me. But I think the I think I completely understand that there is worries in terms of competition, in terms of like growth slowing down. But what I'd say is that like I think a lot of that is already baked into estimates and to sentiment. And I think if the company can just meet these estimates, which I think are fairly conservative, I didn't actually mention it in the presentation, but I mentioned it in the Word document, is that in their Q4 earnings that just went by, they actually beat estimates by 50% because management guided for EBIT of 300 million and they got around 500 and something million. And I was like, that's incredible, that beat. But it's because they were so conservative in good guidance. Now, after Q1 last year, when they missed subscribers, they're not going to be wanting to miss anymore. And so they've been very conservative guidance. And I think if they can just slightly beat that guidance, I think their valuation will keep going up. And I think that will there's ways to make money here, even though the risks are there. But do you have any more like quantitative questions, Fonzie?
no, basically that's it.
Okay.
Those are the questions.
Well, I think if you've got any other questions, I'm happy to like follow up. I can like follow up on any questions.
Thank you very much.
Or
Thank you
any
very
questions
much,
you have.
Nigel.
And, otherwise, yeah, I think this would be a good addition for the portfolio for the fund.
Let's hope so. Thank you very much, Nigel, for your time.
Cheers, Fonzie.